Welcome to this online event that we are holding for the release of the 2020 Climate Transition Finance Handbook. My name is Nicholas Pfaff. I'm the Secretary of the Green and Social Bond Principles and the Head of Sustainable Finance at ICMA. It is my pleasure to both welcome you and to coordinate this event. Despite the pandemic, and to a large extent in response to the grave challenges it has created, this has been a remarkable year for the sustainable bond market and for the work that we are collectively doing to support it. The social and sustainability bond market has expanded dramatically this year with the help of additional guidance from the Green and Social Bond Principles. The sustainability-linked bond market, following the release of dedicated principles, is emerging as a powerful complement to green, social, and sustainability bonds. Today, we are publishing the Climate Transition Finance Handbook that is relevant to all transition-themed sustainable bond instruments, as you will discover during the event today. May I now welcome our CEO, Martin Scheck, for his introductory remarks. Over to you, Martin.
Thank you very much, Nicholas, and a warm welcome from me also, and just a few words at the beginning of today's launch event for the publication of the Climate Transition Finance Handbook and the associated Q&A guidance. Now we're coming to the end of an extraordinary year for all of us in the capital markets, and this is particularly true in the sustainable bond markets, where in fact, as Nicholas has just mentioned, the pandemic has been an accelerant for the sector. We've all seen a spectacular growth in the social bond area, with proceeds used to mitigate the socio-economic impacts of COVID-19. And after a brief lull in the depths of the lockdown, the pace of green bond issuance has rebounded strongly. And it's great to see that environmental considerations are now being hardwired into the government recovery packages designed to rebuild growth in shattered economies. And it's also been a year of significant innovation. We've just heard about the launch of the sustainability-linked bond principles, and these allow issuers to enter the sustainable bond markets based on meeting ambitious and verifiable sustainability performance targets applicable to the issuer as a whole, rather than the use of proceeds concept. I think we can probably all agree that sustainability is one of the two great mega themes at the moment, the other being fintech and digitization. And coming back to today's agenda, within sustainability, the discussions around transition have been growing increasingly loud for the last 18 months. I'm delighted that the Executive Committee of the Green and Social Bond Principles and the Climate Transition Finance Working Group, which involves more than 80 entities representing all stakeholders in the capital markets, have produced this handbook and the accompanying guidance, and many thanks to all of you for your hard work. These documents complement both the use of proceeds-based issuance under the Green and Social Bond Principles and sustainability bond guidelines, as well as the general corporate purpose type bonds issued in line with the sustainability-linked bond principles. They provide clear guidance, and we're going to hear more about the 4 key elements needed for issuers to position their issuance within a transparent and science-based climate transition strategy. And the guidance links to the wider global policy considerations relating to climate change, in particular, the Paris Agreement. And it will be helpful in a broader context as both the private and the public sector grapple with the appropriate levels of disclosure and the increased regulatory focus on sustainability. This continues to be a priority for ICMA in our market practice and regulatory work, and through our participation in official fora, such as the Sustainable Finance Platform of the EU and the Hong Kong Working Group on Transition. That concludes my few opening remarks, and with that, I'd like to hand over to Denise Adaro from the IFC, who chairs the extremely active Executive Committee of the Green and Social Bond Principles, Again, Denise, congratulations on the achievements this year, and many thanks for all of the hard work.
Thank you very much, Martin. It is my sincere pleasure to welcome you all to this event, which marks a milestone for the sustainable bond community and all concerned with the climate change crisis. So the Executive Committee met a year ago here in Washington and established what became the largest working group. The Climate Transition Finance Working Group were tasked to consider the concept of transition finance in the context of the green bond market, and the outcome of which brings us here today. At the annual conference of the principals this year, I made a comment, and that was that I believe that one day all finance will be sustainable finance. The green bond principles, the social bond principles, the sustainability bond guidelines, and of course the recently published sustainability linked bond principles were all steps in that journey, and the handbook published today complements these steps. Steps, in my opinion, that lead to a new low carbon economy. Now, we're all aware of the physical and financial risks that climate change bring. The actual degradation and destruction of assets, the ensuing loss of lives that we're already seeing across the globe, the rising costs and lack of ability to insure against these outcomes. And of course, the assets on balance sheets, which, as we see this year, have already begun being written off and will be written off once policy and financial markets adapt to this new economy. The sustainable bond universe evolved out of the necessity to adapt our financing models to the future path of continued development, but sustainably. The cost of capital for high emitting sectors will see a negative impact, and consumer behavior will also deal with sectors a blow. There is no doubt about that in my mind. Now, you might say that's all well and good, but there are reasons why this is also a risk for us all. And firstly, I would say the political instability resulting from loss of jobs, livelihoods, the redundant skills based on models that will not stand the test of time. This brings in the debate about the just transition that we will hear about as well today. Secondly, some of the infrastructure is not replaceable as yet. There are no sustainable alternatives to some of these things. When we review the activity in the green bond market, as Martin alluded to, it is truly impressive what we've achieved. These products are now established, and this year we saw over $1 trillion in cumulative issuance of green bonds. Undoubtedly phenomenal progress. However, one would note that high emitting sector issuers have been largely absent from this revolution. So I liken the progress we've made in green bonds to an African aphorism, which roughly translates to taking painkillers for someone else's headache. To achieve the global goals of net zero by 2050 and halting global warming to well below 2 degrees, we need to beckon at the high emitting sectors to partake in the transition. The Climate Transition Handbook today offers the bridge for that, for these hard to abate sectors to credibly access GSS bonds financing, to enable them to take the steps needed to arrive at our overall objective of meeting the Paris Agreement climate goals. You know, I commend the working group, the executive committee, for capping off this year, which has been a phenomenal year, as I said, with the upgraded social bond principles, the new sustainability linked bond principles, and of course, the handbook today, amongst a lot of other complementary work that has been done. This brings all the work to this inflection point with a decade to go to 2030 and the 5-year anniversary of the historic Paris Climate Agreement, which will take place this week. So here is to meeting our goals collectively. And I thank you all very much and welcome you again. Over to you, Nicholas.
Denise, thank you so much. And what a great introduction. I remember the comments that you made in Washington over a year ago. And I can only concur with the great year that we've had and the speed that we've all collectively shown. It's my pleasure now to transfer us to the presentation of the handbook itself. And I would like to introduce Farnham Bijoli, Head of Sustainable Bonds, EMEA at HSBC Bank, and Paul O'Connor, Executive Director, Head of EMEA ESG Debt Capital Markets at JP Morgan. Farnham, Paul, over to you.
Thank you, Nick. So it's Paul O'Connor speaking here. So what I wanted to do first is to give everybody an overview of the process to date and how we have arrived at the point we're at now. So the slide you see in front of you gives you an overview of the work that took place during the year. So we established the working group towards the end of last year, and effectively the work proceeded throughout the course of the calendar year. It was to all intents and purposes, a classic market consultation exercise. We established a working group. This was open and proved to be very popular. We had upwards of 140 individual members, I think, by the end. And it was it was representation from all jurisdictions. So it was, there was a wide distribution in terms of the representation there in terms of APAC, EMEA, North America. And also we had representation from corporates as well as many representatives from the financial services sector. So a broad and varied distribution of representation. And I think that's a key point we wanted to get across. Also worth mentioning that we had representation from those territories who, are in the position of needing to look at, making transitions in certain areas of the economy. And so it was critical that we got representation and those voices were heard from those countries where there is obviously a need to consider making this transition. So I think we were successful in getting that representation. That was critical to the outcome of this working group. So the rest of the detail is there in front of you. In effect, we established the group. We had a kickoff meeting for all parties. Importantly, we had an in-person working group meeting. That was probably one of the last in-person meetings we had before the COVID situation struck. So that was quite fortunate in that we had an opportunity to have a good debate there between all the representatives, many of those in person. We followed that up with a series of online consultation exercises where we tried to, I guess, elucidate and get an understanding of how people were thinking about transition finance. So we ran a number of those consultation exercises and the results of those were built into the process. We then had a number of separate calls with different groups, obviously across different geographies, where we sought more input from the representatives of the group. And we combined all that together in an effort to draft the handbook, which is being released today. So in summary, we wanted to highlight the representation and just provide an overview of the mechanics of the process. You'll see also toward the end, we had a number of discussions with the XCOM and with the Green Bond Principles working groups and collected comments and tried to consult as fully as possible before coming up with the draft, which is being released today. So that is all I wanted to say about the process. I would like to pause here and just ask Farnham to maybe offer a few thoughts and reflections from her perspective on how the consultation process worked and how we got to where we are today. Farnham, maybe you could give us a few thoughts from your side.
Absolutely, Paul. Thanks for that. I mean, I think what's important to note is that, obviously this work was not happening in a silo. There is a lot of work underway globally, whether it's the definition of taxonomies across Europe and Canada and Japan, or in the development of new investor stakeholder initiatives, that are putting out their own recommendations and requirements from the companies that they hold. And also, I think just the overall development of the market itself, and companies also putting out new statements and expanding on their climate transition strategies. So I think what was really important was that the working group that was involved in this process really did reflect, a cross-market group of stakeholders, touching on all those different developments. And so the handbook today is meant to incorporate, I think, a view on what's happening globally and ensure that we're very much aligned to other recommendations, not to duplicate any work, not to add to reporting requirements, but rather to clarify and highlight what we think is critical for the issuance of debt when it comes to climate transition finance. So where did we land? I think what's important to note is that this document is a bit different than the work that's been put out in the past by the Green Bond Principles Executive Committee, insofar as it is an issuer level handbook that's to be used in conjunction with the instrument level guidance that we have for green bonds, sustainability bonds, and sustainability linked bonds. And so the handbook is to be used when raising funds in debt markets for any of those purposes, for issuers that are raising funds for climate transition related purposes. And there are four key elements to the handbook, which we'll come into in detail. But the first is that, you know, the financing purpose should be for enabling an issuer's climate change strategy. The second is that the climate trajectory should be materially relevant to the business model. The third is that science-based targets and pathways should be considered when developing that trajectory. And finally, that there should be transparency with regards to the underlying investment program to enable that transition.
Thanks, Farnham. So I think we just wanted to dig into a little bit more detail here. I mean, obviously, you'll be able to read all the detail in your own time, but we just wanted to give you a flavor of the highlights here. And then we're going to debate and discuss a little bit amongst ourselves how these things might be applied in practice. I think in summary and in the simplest possible terms, we have four things here that we believe are important in conveying any transition story. I think the first is strategy. You know, what we wanted to do here was make clear that the purpose of any financing instrument, which it may be labeled as a transition bond or similar, is really about communicating a corporate strategy. It is not something that is peripheral to or something that is being done opportunistically or unconnected to the core of the company's strategy. Transition finance is really designed to communicate a recognition on the part of the company that there may be a change required to the business model, and any financing instrument is really being used to communicate that change of strategy. So I think that is a key thing to try to convey today, that this is really linked back to the core of what the company is about and what it wants to do going forward. The second pillar or element, if you will, is the concept of materiality. We wanted to try and avoid a situation where people, I guess, started to look at this as something new or something that could be used for different purposes. Really, this is quite specific in terms of its intent. And it is really for those companies and those industry sectors for whom climate risk and climate risk management is really a material aspect of their future fortunes. So if you think of carbon intensive or energy intensive industry sectors where their contribution or perceived contribution to the climate change debate is significant in terms of their overall prospects for the future, this is what we're trying to get to. The financing needs to communicate that the company is facing a material challenge to its business model, and the purpose of any instrument that might be issued is really something that needs to reflect that materiality. So this is really for issuers for whom climate is important, and it should be seen in that light. This is really aimed at those industry sectors that are historically have been seen to be part of the challenge, but going forward are more likely to be also the ones that are contributing part of the solution. The third element is all about trajectories and the idea that when a company is talking about how it wants to change going forward, that it references back that plan to what we call science-based targets. Now, what we mean by that is the targets and the pathways that have been set out as part of the overall effort to deliver the goals of the Paris Agreement. So this is about moving towards the goals of the Paris Agreement, and the reference to science-based targets is to move us away from a situation where a company might set its own targets, which they believe make sense to themselves, but it is difficult for an investor to see those in the context of any external frame of reference. So the idea here is if you're setting out a decarbonization trajectory or pathway, for example, you should consider referencing that back to what is understood to be required for the economy to move towards the goals of the Paris Agreement. So that's the idea behind the inclusion of this reference to science-based targets. And then lastly, the idea here around implementation transparency is to provide investors with some understanding of what you're spending money on, and really trying to bring to life your transition plan. And this is by providing some visibility of, where finance and capital is flowing within the business. So are you investing in new technologies? Are you working with partners? Do you have industrial partnerships planned? Are you investing in those? Are you investing in other solutions which will help you decarbonize your business model? So providing investors a sense of where the money is going and how that investment is helping facilitate the delivery of the strategy. That's the idea behind the last element there, which we're calling implementation transparency. So again, I would like to pause there and we can talk through these elements in a little bit more detail. So I will hand back to Farnham to do that.
Let's jump ahead to the next slide as we talk through that first and really critical element, which is around the issuer's climate transition strategy and governance. And I think there are a couple of things that I want to highlight here that came out of the discussions very early on that the working group had. The first is that the concept of climate transition finance very much depends on the credibility of the issuer's overall commitments and practice when it comes to climate transition. There was a clear consensus from the participants in the working group that climate transition finance in whatever instrument form should not be kind of marginal to what the issuer is doing, but rather should be part of a holistic strategy to adapt the business models to make a positive contribution to the transition to a low carbon economy. The second point that I wanted to raise about this is that I think we also recognized very early on and had the benefit from a number of our working group members of realizing that there was a lot of guidance out on this particular element already. And there was a lot that could be leveraged in terms of what disclosures investors are looking for when judging the credibility of a climate transition strategy. And here we really want to highlight that we have aligned the disclosure recommendations here to that of the Task Force on Climate-Related Financial Disclosure and other frameworks, including a long-term target that is aligned to the goals of the Paris Agreement and also relevant interim targets. Disclosures on the issuer's levers towards decarbonization. So what is the kind of pathway and what are the building blocks really towards meeting that long-term target and objective. And finally, around governance, not only just in terms of oversight of and governance of the transition strategy, so looking here really at senior level oversight, but also evidence that the transition strategy fits within a broader sustainability strategy that mitigates other environmental and social externalities that the company may have and can contribute to sustainable development more broadly. And so these elements, as mentioned, are very much already highlighted in many reporting frameworks that can be leveraged for the disclosures required under this element. And the idea here is that issuers can make use of the disclosures that they're making elsewhere. It could be relevant in the context of a debt issuance to include some sort of verification of that issuer level strategy. Indeed, I think from the view from a lot of the external review providers who were part of the working group is that this is already a part of an external review of a debt issuance. But that the technical review here could include alignment of both the long-term and short-term targets with an overall climate scenario aligned to the goals of the Paris Agreement. And finally, that there would be an assessment of kind of the credibility of the issuer strategy to reach those targets. Pass over to Paul now to speak about the second element and some of the thinking behind that.
So the next section is about environmental materiality and materiality of climate change to the business model. So as I mentioned, the idea here was to make sure that if there is a transition finance market which emerges, that it is really focused on those issuers and those industry sectors that could probably make best use of it. And in a way, it's an effort to make sure that we don't have ideas in play which really are not going to, I guess, move the needle very far. This is really about the issuers and the industry sectors that have probably got most to contribute in terms of the overall effort to deliver Paris goals. So there are a number of ways to think about materiality. And effectively, it can be a combination of whether or not your prospects as a business will be impaired by government intervention, for example, to limit carbon emissions, or whether you are exposed to technology change, i.e. the demand for your product may drop off as a result of other low carbon or zero carbon alternatives becoming available. Obviously, that would be a material issue for certain industry sectors. And the extent to which the actual level of emissions and your overall contribution is significant in the broader context. Obviously, if you're only a very small emitter of greenhouse gases, for example, it's hard to make the argument that it makes sense for you to consider using transition financing. So you need to put a number of things into consideration, your overall contribution and that of your industry sector, and the extent to which you feel your business model may come under pressure as a result of what they call, I guess, the inevitable policy response, i.e. that globally and at an economic level, we shift in a low carbon direction, and that shift may have implications for the returns that you can make by deploying your current business model. So there's a lot of flexibility here. As you can see, it's very high level and non-prescriptive. And really, it's very hard to move away from a situation where we can define rules or guidelines that are applicable in all contexts. These sectors that are in play here are very different to each other, and companies within those sectors have different operating contexts. And so we need maximum flexibility here to allow potential issuers of transition finance instruments to talk about materiality in a way that makes sense for them. So ultimately, this is all about disclosure and transparency and building up that dialogue with investors to help them understand, how you look at this and why it's relevant to you and why a financing instrument and asking for their engagement and support might make sense. So I will leave it there on that one, and we will pass on to the next one that Farnham can talk about that.
Super. So the third element is around the fact that the climate transition strategy should be based on science-based targets and pathways. And so I think the key takeaway here is that investors expect that the transition trajectory should be something that is quantifiably measurable, that it should be benchmarked against science-based trajectories, where these trajectories exist, and that this should be publicly disclosed and ideally also verified by independent assurance or other bodies. There are clearly here a number of methodologies and bodies that are already providing verification around science-based targets and pathways, such as the ACT and the Science-Based Targets Initiative. So here again, I think the emphasis is on leveraging that work that's likely happening already at the corporate level. But really, for the investor perspective, what was important here was that the pathway be something that could be benchmarked and measured, both in terms of contributions to the goals of the Paris Agreement, as well as about the sectoral decarbonization trajectory. I think we had a number of conversations at the working group level about the measurement methodologies that are out there. So there are a number that are referenced within the handbook itself. And this is in no way an endorsement of specific methodologies. And we recognize that additional methodologies may evolve over time, and also that depending on the sector, the decarbonization trajectory may not still be well-defined and may rely on a fair amount of technological innovation and disruption. But again, here to echo Paul's points on the point of materiality, the key here is very much around transparency and disclosure, and the corporate or the issuer being clear on the target and the pathways to go towards getting there. I'll pass over to Paul for the last element.
Okay, so just briefly again on transparency, I think again we need to have flexibility here, and there will be different ways of approaching this. As I say, the idea is to give investors some sense of how the financial planning and investment is supporting delivery of the strategy. Now, one thing we commonly see is quite a lot of disclosure and reporting in the public domain from companies who are talking about the various things they're getting involved in, whether that be renewable energy, whether it be low carbon transportation, hydrogen economy, carbon capture and storage, things of that nature. But it's sometimes difficult to see what volume of spend, CapEx or OpEx, et cetera, that represents versus the spending that's going on more generally in the business, which is linked back to the original business model. So I think that's one thing that probably may need to be looked at as we move forward. And in the context of positioning any transition financing instrument, I think it would be sensible to consider giving investors an understanding of what volume of spend is concerned here and where it's going effectively. In the green bonds market, we already have mechanisms for this through the annual green bond report, for example. So there are established approaches and ways of doing this if we think about allocation reporting in the green bond space. So there may be some lessons to be learned there, but ultimately, this is, again, something that really would be best left up to the issuer to decide. But I think it would be reasonable to assume that some sense of what proportion of overall financing and CapEx and OpEx flow within the business is linked back to the new strategy and the decarbonization strategy or the climate transition strategy or whatever we're going to call it. You know, we need to see that the money is coming behind the strategic intent. And I think it's reasonable to assume that there will be some expectation around that so that investors can be reassured that, you know, the flows are happening in a way which is leading to a meaningful scaling up of these new technologies. And as we scale them up and prove them out, the economics tend to improve. And I think we need to see this finance flow to give everybody some reassurance that these strategies, decarbonization strategies, are actually coming to life. So that's, I think, all we wanted to do in terms of covering the content. As I say, there is more detail there available to you, but I think we are almost out of time for our section. So with that, I will pass back to Nick and we can continue with the rest of the session. Thank you.
Paul Farnham, thank you very much. So for the panel, I'm going to now turn to our moderators. We have Yo Takutsuki, who is the head of ESG research and active ownership at AXA Investment Managers. And we have Robert White, executive director, Green and Sustainable Financing at Natixis. Yo, Robert, over to you.
Thank you very much, Nick, and hello everyone, and great to be talking to you on this day. I think before we hand over and introduce all our panelists, what will hopefully be a very fruitful discussion, just a few comments from Yo and myself, really around how we perceive the launch of this handbook and its importance. Certainly, you know, from my view, is that climate finance will fail in its mission if it leaves greenhouse gas intensive sectors on the sidelines. So certainly the hope is that this handbook provides that key guidance for those sectors to credibly access capital markets. And I think that really is worth reiterating one of the points that Farnham made earlier, which is around just how this is a little bit different from what's been put out in the market before. It's very much focused on the thematic. It's focused on the issuer level strategy. It is not looking at the underlying format. So an issuer can still, of course, issue green bonds, can still issue social bonds, sustainability bonds, or sustainability linked bonds. But where they are looking to raise capital to help them move and help them drive their climate transition strategy, then our hope certainly would be that this handbook provides additional guidance on the type of disclosures, the elements of disclosures you've just heard, and the level of transparency that would be required. But Yo, your thoughts, how would you like to see this being used in the marketplace?
Thanks, Robin, and thanks to everyone who's been involved in this effort, because it really has been a global effort. The first attempt really to try and define and frame the concept of climate transition financing. And what's become clear is that this is something that sits within the broad range of dialogue that's taking place around achieving global goals around the Paris Agreement. And what we've tried to do here is to also enshrine achieving the Paris goals as a really critical goal or the objective itself of the climate transition financing. So it's not just about incremental business as usual decarbonization efforts. This is something that's ambitious, intentional, strategic, and hopefully as a result, would be to constantly change the status quo and achieve hopefully some of the big targets we have in place to hit net zero by 2050. More broadly, I think this will also have some kind of specific knock-on effects. So for investors, this is common language to frame our discussions with issuers that takes place at the point of financing, but also the broader engagement dialogue. For the wider stakeholder base, such as governments. For example, in Japan, there's a lot of discussion taking place amongst the ministries, the major ministries there. They have a strategy being put in place around climate transition. That's the goal that they're putting in. That's the language that they're putting in. And a lot of activities happening there around the concepts, but also using this handbook as the base to build that up. But I think also, this handbook sits within the context of wider, broader innovation that's taking place within the markets around sustainability financing. We want to keep kind of help encourage that over time, and I think that's important. And so, for example, in the spirit of innovation, our firm, AXA Investment Managers, we recently invested in a €100 million private placement from Natixis' parent entity, BPCE, with the French bank, and that was a transition bond. And it's something, Rob, you might be able to give a little bit more flavour to.
Sure. And really it was around driving, additional innovation. So not to be directly linked to this handbook, but certainly providing, again, new forms of developments in the market, where ultimately a private placement underpinned by what we consider to be dedicated transition loans, and really focused on those that are sustainability linked loans, where we feel that the KPIs are strongly tied to climate and energy transition. And so it's well suited to capturing that holistic, dynamic, forward-looking dimension that we'd like to see from the corporate sector. Also, we can look at including project loans as well, really looking at our own innovation around our own internal green weighting factor, which effectively assigns a climate score to dedicated purpose financing. And it allows us to look at assets such as, for example, project loans in the metals and mining sector, bauxite, copper, those that are very key for enabling the energy transition to a low carbon economy, or those looking at energy transmission and distribution assets, and equally those looking at driving, low carbon aluminium, for example. So just to set a bit of context there. So I think it is exciting that we continue to see innovation in the market. It's great that now we have this handbook out there that can provide additional context, additional transparency as well. And hopefully a good session now to dive into that in a bit more detail. So if you could.
Absolutely. Yeah, thanks, Rob. And I'd like to introduce the panelists now. We've got a great set of panelists. It's not often I get to say this, but in this case, we really got to have the four favorite picks that we wanted for this panel. So from my own perspective, at least, thank you very much to the panelists in advance for making themselves available. So we have Adam Matthews, who's the Director of Ethics and Engagement at the Church of England's Pensions Board, who's also the co-chair of the Transition Pathway Initiative, and he's speaking to us from Edinburgh today. We also have Johannes Boehm from Union Investments, ESG analyst there, based in Frankfurt. And on the corporate issuer side, we have two speakers with us. One, Susana Messeguer, Director of Finance at Repsol, the oil company in Madrid, and also Sergio Molisani, a Director of Finance at the gas provision company, transmission company in Italy, Snam in Milan, is joining us today. So thank you so much to all of you. I'm going to start with Adam. Adam, you are involved in the broad range of investor dialogue with companies, with the market, the research assessments that's taking place, and you play an important leadership role in that. How do you see this handbook, but also the concept of the finance as a module within that broader dialogue?
Thanks, Ewan. And first of all, just to sort of congratulate everybody on the work in putting this together, because I think what you're doing is you are building the architecture for the capital markets to play their role in supporting the transition. And here you've distinguished clear ways in which finance can be released to support the transition, and I think that's hugely important. We've all got a stake in playing our part in this. We have a collective responsibility, and equally it's from a pension fund perspective, very much our beneficiaries' interest to see our investments playing a positive role in enabling the transition. And I just think we're in an absolutely critical moment where you have companies setting net zero objectives, they're setting targets aligned to that, and really they're putting in place transition plans, which have quite a lot of complexity, particularly within some of the hard to abate sectors. But we're at this point now where we are seeing companies really starting to detail how they get from where they are today to aligning themselves to those long-term goals that have been set by the Paris Agreement. And key to that is the ability to access finance that can enable that transition to happen at pace, and being able to do so in a credible, transparent way that's consistent with the goals of the Paris Agreement. And I think what you've done today and what you've launched today is a key part of that jigsaw that needs to be put in place, which is really sort of how do we do that in a way that's transparent? What are the principles, the basis of which you can release that finance? And how can you determine if that company's plan really is credible? And so you've obviously got major engagement taking place with many of the hard to abate sectors through Climate Action 100. I see this as an absolute parallel, complementary part of the puzzle that actually sort of coming together at the same time. And I feel that we're going to be developing this over the coming year, 2 years, to really have that architecture to find in a way that really means we can identify those companies with credible plans, credible targets, and are able then to access the finance that can really ensure that they can deliver on that. And I think the underlining of the disclosure, the transparency, and I think the opening sentence on the actual document itself, the credibility of an issuer's climate-related commitments and practices. I mean, this is what this is really about for me. It's about defining that credibility, having a basis to then really release the finance to enable it to be achieved.
Thank you, Adam. I'm going to turn over to Johannes now in Frankfurt. You obviously look at these types of investments in the fixed income markets, use of proceeds bonds and the newer sustainability linked bonds. How do you see this handbook sitting within the context of how you assess your investments and their alignment with broader sustainability practices and goals?
Right. So first of all, thank you very much, Jo and Robert, and thank you very much, of course, for having me on this panel. I am indeed very excited about the launch of the handbook because I very strongly believe it'll contribute to bringing about nothing less than a new phase in the sustainable bonds market. And one key aspect of this is that much like green bonds or social bonds have fostered a dialogue between investors and issuers in the past on green or social aspects of their businesses, the same will now also be true with a particular focus on the transitioning of entire business models. And I also feel that the investor side has increasingly been moving beyond traditional, say, exclusionary approaches in sustainable investment, and has been giving more thought to how they can accompany certain issuers along the pathway to a more sustainable business model. Now, the publication of the Climate Transition Finance Handbook, in my view, reflects and supports this dynamic and really adds to the market by providing specific guidance to market participants regarding the relevant components of a meaningful and credible transition strategy. And as such, the handbook will be particularly relevant when it comes to determining the shade of green of certain green or sustainability-linked bonds, namely by adding that additional layer of transparency and credibility, as Adam mentioned, to the issuance. But importantly, climate transition finance also makes that link to the whole of the issuer's business model. And so it'll also be an opportunity for investors to get a more complete understanding of where the issuer is headed. And I'm therefore very excited to see issuers come to market with the handbook in mind and embark on that transition journey going forward.
Thank you, Johannes. I think that's an incredibly valid point, especially the move away, if you like, from just a pure play exclusionary criteria from the investor universe, and that accompanying of an issuer as they embark on this journey. And it is a big journey, and it's an important one. And for that, I think it'd be really great to hear both Sergio, Susanna, from yourselves try and really bring some of this handbook to life. It focuses on a number of key disclosures. If there was a theme I could put over a thematic-based handbook, if you could humor me the phrase, it's really around transparency. And I'd love to hear from both of you around, how your respective organizations, how do you undertake climate scenario analysis? What external guidance tools do you use, given that that's one of the elements for disclosure? And then, of course, how does that fit in once you've run those scenarios into your own strategy? So perhaps first of all, Susanna, I'd love to hear your thoughts, and then we can hear from Sergio.
Okay, thank you, Robert, and thank you all for having the opportunity to be here as the voice of the issuers. We have participated in the working groups, and it's been amazing and a very good effort from all. So thank you very much. Well, in fact, scenario analysis for us is a key activity at Repsol, because it helps us first to understand what happens in the energy world, the global tendencies, policies applied, and this is very important for us in order to understand how our company has to evolve in the coming years in order to adapt to a low emissions future. And there is a number of scenarios, projections available from multiple sources. But for us, we are using at this moment scenarios from the International Energy Agency, more precisely the Sustainable Development Scenario. And also, more recently, the agency is also developing the net zero emissions by 2050. So with these scenarios, and then considering the reality of our company, we develop an internal company central scenario that is going to frame our company strategy towards the net zero emissions in 2050. No? So with all this, we can set a decarbonization pathway by trying to apply the different levers that we have, no? And not only what kind of levers and their intensity, but also the precise moment where they are more efficient and effective. So after iterative exercises, we are able to draw a strategy and to set specific climate goals throughout the time, and based on precise actions. No? And it is very important how to monitor the progress on this. No? And for this, we have defined, in particular, Repsol has defined a key metric, which is the carbon intensity indicator. And this metric basically measures the CO2 emissions, scope 1, 2, and 3, per every energy unit that we produce and supply. And this is the main tool to be able to measure the progress on our commitment to be net zero emissions in 2050. No? Then, based on this indicator, we have defined a clear decarbonization pathway, which I think is critical for this. No? And we are setting not only the ambition, but also a short, medium, and long-term quantitative goals. For example, we are monitoring a 3% reduction of this carbon intensity indicator by 2020, reaching 25% in 2030, and reaching 50% in 2040. So with regards to science, well, for us, this carbon indicator reduction target is a science-based target. Currently, as you may know, there is no methodology for the oil and gas sector. There are several initiatives in progress to try to establish a benchmark for the sector, and Repsol is actively participating in some of them. For example, the Science Based Target Initiative is elaborating a dedicated methodology for the oil and gas sector. Also, Climate Action 100+ is promoting a standard net zero benchmark. So in conclusion, we have defined this indicator to monitor our decarbonization pathway, and we do consider it is a science-based target, but for sure at the same time, we keep on working and participating in all these initiatives in progress to set a benchmark for the sector, which is really important.
Absolutely. And I think what I'm take away from that is it's not just the when, it's the how, and of course it's the governance that sits over all of that becomes really key, and actually points to a number of the elements within the handbook. Sergio, love to hear about how that gets applied at SNAP.
Yes, first of all, thank you everybody for the invitation and the impressive efforts we produced in the last few months to be here today, and glad to see that after a lot of skepticism at the beginning when we started in early 2019 with our first transition bond, nice to see that today there is an alignment of interest among corporate banks, among credit agency and investors ready to put at work the abundant money available linked with ESG mandate, and giving the benefit of the doubt to those companies that even if they are not pure green, they are ready to activate all the levers under their control to make it better, to reduce the impact of their activities, and to avoid the over-orthodoxy means a missed opportunity for all of us. Having said that, I would say that given the importance of our strategy to make the existing infrastructure and the green gases key players to support energy transition in the first phase and to achieve long-term decarbonization targets in the long term, and given the importance for both our long-term growth and the entire community interest, our preference is to rely on proprietary model and scenarios just to avoid any, I would say, black box issues, and to be in the full control of the analysis supporting our long-term investment decision. Needless to say, as already mentioned by Susanna, that our models are fed by projection coming from the most relevant research institutions, such as the International Energy Agency, the Energy Information Administration, the European Commission, etc., etc. But more importantly, they are consistent with the Italian and European legislation, in particular the policy target embedded in this legislation. They are regularly updated to reflect any evolution in terms of market development, policy development, technology development, but more and more importantly, they must be proven and accepted by the regulator in terms of accuracy of assumption and projection, in terms of compliance with the commonly recognized methodologies. In particular, they are always scrutinized by the regulator and a large number of stakeholders as part of grounded consultation process, long-lasting consultation process, and cost-benefit analysis in the interest of the countries. And I think that a good example, a virtuous example of this approach is the cooperation we implemented last year with Terna, the electric transmission system operator in Italy, in order to produce a shared and consistent vision up to 2040 of the energy system in Italy, both on the electricity and the gas sides. This scenario was, this exercise was consistent with integrated national plan for energy and climate, and so the European defined targets, and has involved many stakeholders and the entire government in Italy. The results of this scenario are were very supportive for us, because they demonstrated that even under the most conservative assumption, the gas network in Italy remain key, and for two reasons. First of all, because of the development of the green gas, biomethane, first of all, and secondly, due to the flexibility and security needs of the country. We expect more supportive results coming next year on the occasion of the review of this exercise, is because we expect a growing contribution coming from hydrogen, also considering the strong legislative and political support we are recording in the last few months. Just to give you a number, we run a scenario where the penetration of hydrogen is 25% in 2050, and in this case, the volume transported in our network increased by 30%, from circa 70 to 90 BCM. This is a very important outcome of the analysis for one reason, because it convinced ourselves further on the fact that keeping in good shape the current network, the current infrastructure, means having the possibility to make hydrogen more fast to the market at the most economic conditions.
Thank you, Sergio. And I think it highlights that additional piece, really, which is that interplay between, once the scenarios are run, be it with international and regional inputs and your own insights, it leads to that piece around the fourth pillar of this handbook, of course, the transparency around how you see future expenditures leading to the enablement of those strategies, and actually how you can see it come to light. And it's really those stories, it's the color that puts around it that I think is quite exciting here.
No, I think one thing I'd definitely add, and it's becoming quite clear from everyone's comments, but also what was discussed quite extensively in our market consultation and also in the working group, is that the first 10 years of this green finance revolution, let's say from 2010 to 2020, we spent a lot of time doing a stock take of what was out there. It was almost as if we were doing a footprinting exercise, as I would put it. You know, what do we have today? But over the past couple of years in particular, it's become much more about, okay, then where are we headed? And this recognition, quite sobering recognition, that to meet net zero, we would have to take half the human-made, man-made carbon emissions by 2030 was going to take a massive push to achieve it. Now, a critical component, I think, within this thesis, this effort has been how do we model the future? And within the four pillars that we have of this handbook, the third one, which is about forward-looking targets, forward-looking transition pathways, so the road that you take, it's a big area that's quite new. And I just wanted to put a question to Adam. You probably are the market leader bringing forward some of these ideas to us, amazing tools being created. Just give us a little bit more information to investors, but also issuers embarking on that journey of looking into the future.
Yeah, thanks. Yeah, I mean, obviously, through the Transition Pathway Initiative, you've got a tool that's been created by asset owners to support that understanding, because I think it's absolutely critical that you have independent, academically robust tools that can really enable an understanding of where a company is heading against that long-term trajectory to 2050 and sort of points before then, and where their targets or objectives sit against the goals of the Paris Agreement, be that 1.5 degrees, be that 2 degrees, and equally where government policy currently is, the NDCs. And we now get into a point where, I mean, 3 years ago, I don't think we could have had this conversation with Susanna at Repsol, because I just don't think we were in a position where either the investors or the companies were talking in a language that was common with each other. And yes, there was a huge amount of detailed disclosure, but actually, were the targets relating to forward-looking objectives? How could we independently measure that and understand where what you as a company is saying translates through to something that we can look at externally and have confidence in that independent assessment? And then once you've got that basic understanding, well, then we can get into the real conversation around, okay, how are you going to achieve it? Where's your strategy that's going to deliver those objectives? We know it's aiming to be there by this date. We've independently been able to check that. And now we're looking at the strategy. We're looking at the underpinning levers that you're going to be pulling. And where is it that you're going to need the additional finance to inject new technology to enable you to go faster, to achieve this, etc. And I think that's the territory we're now in. And credit to Repsol for the interventions that they've, the statements they've recently made, because I think we're at that level of dialogue with companies like Repsol in a sector that 3 years ago I would have had a blank page in front of me if I was looking for a tool that really looked at where they were against 2 degrees and 1.5 degrees. We do need an International Energy Agency scenario. It's absolutely critical that they build out the one that they've recently started to reveal, and I think that's essential that we have those sector pathways. And investors really have got to work with companies in understanding their transition plans against 1.5 degree in these hard to abate sectors, and then really looking at really how they relate to their value chains and across the sector and the interventions they need to happen that they can actually engineer, and those that are actually going to need to happen that aren't necessarily in their control. So I think we're in that territory now, and I think this territory is going to move very quickly over the coming 2 years. And as I say, we are building an architecture here that will enable the transition to happen and for finance to play the role that it needs to in incentivizing, in enabling, and ultimately also in holding accountable.
Thank you, Adam. And what we were thinking about quite clearly was not to create additional burden for issuers to do more work than they were already doing, but that the information should be provided to investors at the point of financing in a way that would be easy for us to digest. As many of you will know, bond market activity is quite fast. It comes in the morning and it's gone by the lunchtime. And so sometimes, we need this information made readily available to hand. I mean, Johannes, you get your fingers dirty every day doing this type of work. The information provided through kind of structures like the TCFD, aligned reporting. How do you see that all fitting in, and what kind of minimum level of disclosures would you be looking for when assessing these types of deals?
Right. So, apart from what is already set forth by the sustainability-linked bond principles, or alternatively, the green bond principles, what we specifically look for when we look at transition strategies of corporates is, first, what are the key financial and environmental material aspects of that strategy? Second, what does the trajectory look like, and what is the ultimate target? Third, and importantly, did you embed all of this in your governance to ensure that real action is taken? And last but certainly not least, does your strategy materialize in pertaining investments or divestments? Because we would, of course, like to see companies not only talk the talk, but also walk the walk. All of these points, along with a couple of others that are very important, I would say are well covered in the handbook. And I would like to encourage potential issuers to take them into consideration in order to come up with an ambitious transition strategy and in order to get the word out in a credible manner. Ultimately, what we try to figure out when looking at sustainable bonds of all sorts is, does the issuer really take a proactive and affirmative stance towards sustainability aspects? And does the sustainable issuance therefore fit well in the overall context of a meaningful and ambitious sustainability strategy?
Thanks, Johannes. I agree, and I think it's incredible, and I wouldn't mind you diving in just a little bit more, actually, just on one piece as we drive into this, which is, of course, how does that then create, in terms of the guidance, if you like, the on-ramp? We have here on our panel, of course, real leaders representing the issuer community in Repsol and Snam, but equally, of course, not everyone is at that point in the journey. So I'd love for you to just maybe unpack that a bit more and give your own thoughts on how you see the on-ramp as well for those, perhaps at the start of this journey too.
Right. So I have the feeling that when it really comes to determining whether the shade of green of a particular issue, it really comes to down to taking a deep dive together with the issuer and really trying to foster that dialogue and talk about the material aspects of the business that are key in terms of financial materiality, but also in terms of environmental materiality. And my impression and experience is that a lot of this you will find out at the moment that you really engage in a dialogue, because this is the point in time where you really get an honest sense of how ambitious really and how well credible really is the issuer tackling its own transformation towards a more sustainable business model. So, in that process, of course, we take into account all of the components that are, on the one hand, now covered in the Climate Transition Finance Handbook, but as well, all the other components that have been long-standing so far, such as the TCFD, such as investor presentations, all the good stuff, as well as SPOs, of course, that we take into account.
Yeah, and great comments from Johannes, and I think Adam would definitely agree with me. But behind the scenes, there's a lot of engagement dialogue taking place between investors in different countries. Susanna and Sergio, we've got to know each other quite well over the years. But when we first started having this conversation, I think as Adam alluded, and this goes back a few years, our joint understanding of this issue was more simple. But I think together we've learned, what works for investors, what works for issuers. And I think that is really part of that achievement as well, that all of us started at a point where we knew less about this. And for the wide range of companies that we get approached for dialogue about, whether these are smaller companies or in companies in markets where this understanding hasn't permeated to the same degree, I think what we're looking to see as investors is that kind of willingness to take that first step, because really the first step then leads to something that's meaningful, that's ambitious, that's aligned with Paris, but it doesn't just happen overnight. And, I think for investors like me, and Adam, I see him in action all the time, Johannes too, we want to play a role in fostering that understanding. And this handbook is really one of the components that hopefully would allow us to be able to do so in the future.
So, if I could just sort of respond to that very briefly. I think it's about having that dialogue, and I think those sort of headline commitments of net zero and sort of related targets are critical, because that's sort of confidence building. We're both talking and aiming for the same thing, but then it's about the dialogue underneath that on that achievement. And I think in sectors, when you look at steel, for example, where we're talking with the sector and it's trying to understand, well, what technology is going to play what role, with what company at what level, and then having that clarity, and then sort of looking at the feasibility of that even down to the site level. And I think you're going to need to get to that level of granularity to understand how you can then release finance to enable that company to achieve its objectives. And I think we're still on a journey of that sort of disclosure and transparency, but we know the parameters now. And I do think that it's an exciting time where actually we're going to be working together to drive this. It is a partnership ultimately. And I think the parallel sort of work that's going on the equity side with Climate Action 100, there's a convergence here, and that's happening over this year. And I think 2021 is going to be absolutely critical in bringing these paths together in a much more constructive way. And I'm sort of excited by the opportunities, really.
Thank you, Adam. I think one of the ways we're particularly intrigued to hear from this panel is, obviously the handbook's available to anyone. It's available really to articulate that anyone that's looking to raise, whether it's a use of proceeds format, say a green bond or a general corporate proceeds, but with forward-looking targets, so in the form of a sustainability linked bond, but where the proceeds are going towards enabling their climate transition strategy. And of course, that's something that affects almost all issuers to varying degrees. But naturally, there are some areas of the economy where perhaps it's more relevant, and there are equally other parts where perhaps this handbook will resonate the most. So I'll be intrigued both from the issuer viewpoint, but also from our investor panelists as well. So Adam, Johannes too, where do you perhaps envisage this handbook being the most useful? Be great to hear your thoughts there. And perhaps anyone dive in, but maybe Johannes, your thoughts.
Sure. So these are clearly the so-called harder to abate sectors, such as cement, steel, aluminum, shipping, aviation, and so on and so forth. And while in principle any issuer could issue a regular green bond, for example, companies from these sectors have had some obstacles, some additional obstacles, I would say, to overcome in the past. Given that they either do not have enough, green assets, or if they do, some companies had reservation to issue a green bond due to reputational concerns, given the heightened public scrutiny they are under. So overall, I would say the handbook is most useful for those issuers whose concerns and requirements the green bond principles did not cater for in full so far, which can be met, however, with the additional guidance as provided by the handbook.
Adam, any additional thoughts on that front?
No, I mean, I think that I absolutely second that. And I just think that the dialogue that's happening in parallel through Climate Action 100, many of these hard to abate sectors, many of these hard to abate companies putting in place strategies. You'll have a benchmark from Climate Action 100 in February 2021. And there you're going to be having a much greater level of transparency around what the transition plans look like, how capital expenditure is being aligned to achieving those objectives. And I think bringing this now as part of the discussions with the companies in terms of bond issuance and how they can be enabled with this kind of framing, I think is absolutely complementary. And I think these two tracks need to be much more joined up now over the next 2 years.
My opinion is, I agree. I mean, this initiative is clearly very positive for sectors that currently are not green, but are committed to and have already started a transition that is going to be deep, complex, usually, and has to be credible for sure, because these transitions are going to require a big amount of funds, and the reality is that access to sustainable finance has been very limited in the past. I mean, so for example, oil and gas is clearly an example. Repsol in particular is willing to be an active player in the transition financing market once we have issued our strategic plan recently. And I would say that this is a good guidance for all sectors, but mainly for those under transition, that I would highlight that not being able to access the sustainable financing market, not only because we do not have projects that, for example, in our case, we do have green projects for the future. I mean, 30% of our CapEx is going to be allocated to low carbon CapEx. But it's true that a transition financing framework was needed, because looking at an oil and gas going to issue a green bond was a kind of difficult. No? So this handbook this handbook, setting a clear framework in relation to climate transition is going to be a key for these kind of sectors and for accessing to sustainable financing.
Just to maybe dive in on that a little bit more, Susanna, do you see it therefore acting, if I'm hearing you correctly, as a bit of a bridge, if you like? It provides a way for issuers such as yourselves in, perhaps the harder to abate sectors where in the past the dialogue's been trickier, engage with investors under a common language with which you can then articulate the strategy. Is that what I'm hearing?
Yes, and definitely Adam, Johannes, all of us, we have mentioned the dialogue and the commitment and the transparency between investors and issuers is going to be key. Because it's true, the transitions are not simple. Even every company within a sector is different. So I think we have to reach a common point. And if issuers have a credible transition and we can be transparent and have different goals. So I think it's fair to say that it's fair to access financing, and this handbook, I think, is like a first step and a framework for that understanding in order to be able to access the financing market that is necessary.
Thank you. And Sergio, I had a question for you. You are very much a pioneer in the market, and you've now done 3 transition bonds to the market. And just we realize that there's the technical element, which is structuring the bond, creating the information around it. But then there's the other bit, which is around buying the support and loyalty of internal stakeholders to support you on, I'm guessing, what can be sometimes a tricky challenge. Give us a little bit of the flavor of how you've managed that aspect too, because I think that is something that we hear as a potential hurdle to coming to these markets more visibly for many companies.
Of course. But if I may take just 20 seconds to follow up on what Susanna said, it's very important. I want to enter into the detail of the structure of the handbook, but I think the most important thing to stress today is the underlying message of this chart book, is that today banks, asset under manager, rating agency are ready to give the benefit of the doubt to those companies that even if they are not green today, they are taking seriously environmental themes and they are working seriously in order to produce some benefits to their strategy, but to the entire financial community. So this means for us having the possibility to elaborate on how we build up our scenarios, how we come to an investment decision, what are the actions and the results of this action in the medium to long term. And back to your point, Jo, what's important to gain the credibility, first of all, of the market, because our decision was to rely on use of proceeds and ad hoc reporting for a simple reason, because we believe that reputation and credibility in the market is a unique way to have a constructive relationship with investors. And that's the reason why we want to build up our track record before asking the financial community to accompany ourselves in something like that it's, I don't know, European taxonomy, green compliant, et cetera, et cetera. So credibility, transparency, track record is important to get traction from investors. But I would say that we didn't make any painful, I would say, efforts internally, because at Snam, transition, it's strongly integrated in our strategy. And the reason is very simple. We invest something like 1.5 billion per year, roughly speaking, in infrastructure having an economical, technical life of 50 years. The payback of this investment is very, very long. So we cannot take our decision based on the current market condition or our gearing today or what we expect in the next 3 to 4 years. We have to project our investment decision in the medium to long term, well beyond 2050. So the question and the team discussed today, what's the evolution of the market, hydrogen, green gases for us, et cetera, et cetera. It's something that will determine our destiny and our growth in the medium to long term. So the company was perfectly aware of these themes and followed ourselves in our effort to align the financial strategy of the company with the corporate strategy of the company. And that's the reason now we have an ESG unit, we have a strategy unit taking care of these themes, we have a sustainable finance unit. So the entire structure of the company is shaping itself in a new way in order to accompany the secular trend of the industry.
We're getting very close to the time where we're going to be handing back to Nick and then starting the Q&A session. But I think there's one question that is bound to come up, and it would be good for us to really have a debate on it here on the panel as well, which is, of course, does this release of this handbook give rise to a transition bond label? Does it enable that? How could it be used? Where could it be used? And all the dialogue around that. It's an open question. It's going to be, and I think there's some differing views on that topic. I certainly have my own view, but perhaps, Yo, I might hand to you for your thoughts, and then I'll be very intrigued to hear our fellow panelists as well.
As you know, there's been a lot of discussion about that aspect of this debate, but let's be absolutely clear. What became clear for everybody involved within the working group, but the broader dialogue around it is that this is an exercise focusing on the outcome and credibility. And so what we mean by outcome is about achieving Paris. Credibility aligned with climate science. That's what really is the most important thing of all. Now, labeling is really how you signal to the market, to the wider stakeholder base, of how you then are aligning yourself with those end outcomes and the credibility around it. The way we've structured this handbook is to say, if you want to come to the market and you're in certain types of sectors where you are fossil fuel dependent currently, but have the intention of decarbonizing rapidly to help achieve Paris, then these are the kind of building blocks you need to be able to credibly come to with no fear of the reputational risk, the sustainability linked market, and then all the use of proceeds, bond markets, green social sustainability bonds that are out there. So when we are going to see in the future things that are called transition bonds, essentially it's going to be capturing a wide universe of bonds, but most specifically, it's going to be focusing on the credibility of trying to achieve that outcome. So I think the long answer to it is that the handbook isn't really about that, but I believe that the process of doing so and companies thinking through it would mean that they would actively, increasingly want to connect themselves with this Paris-aligned, scientifically credible idea of the climate transition.
Robert, Yo, thank you very much. That was a really interesting discussion. We have quite a few questions, and what I would suggest for all of you, and again with Robert and Yo's help in terms of directing these questions, I think relatedly to this question about labeling, there is confusion in some of the questions about whether we are creating a separate transition bond category or whether this transition guidance applies to use of proceeds and sustainability linked. So I just like to put that to you. I know we've addressed it, but I think we should say so again because there's still confusion.
I think this is one, Paul and Farnham, I think it would be great to get you back in the discussion. So would one of you guys like to volunteer? I've kind of already had my say on it just now, but Farnham, Paul?
Yeah, I'm happy to offer a few thoughts on that. So from my perspective, it's really ultimately something that is down to the issuer and the investor. Everybody will have their own views on these things, and it is very hard to create a set of circumstances where we have something in play that will work for everybody. There are very, very, I guess, specific circumstances attaching to each company and different industry sectors. So I think the label really should be left to the discretion of the issuer. It's up to the issuer to build a rationale and construct a case for using that label, and it's ultimately up to the investor to accept it. That's kind of how I look at it. And so I think we still have that flexibility there. And I think this is all about the music that's being played, not necessarily the instrument in the orchestra. And if the music is right, I think we will make progress.
Paul, but just narrowing it down to the other aspect of the question, which is, can you use this guidance both for use of proceeds, so a typical green bond, or with one of our new products, sustainability linked bond? Does it apply to both?
From my perspective, yes. This can be used to underpin a traditional use of proceeds instrument or one of the sustainability linked bonds. So I don't see any issue with that. I think this facilitates both. Some issuers will find the use of proceeds structure more appropriate for them. Others will find the sustainability linked bond structure. Again, I think this can underpin both. So I don't see necessarily any specific issue there.
It really does talk to the thematic. The thematic is around climate transition. And of course, you may look to raise proceeds to fund that strategy in a number of different ways. And so it works incredibly well, whether it's a green bond, whether it's a sustainability linked bond, or even potentially a social bond under, we all know in certain sectors of the economy, rapid decarbonization is going to lead to an impact on the workforce and the concept of a just transition. So I think it's important to note this is issuer level guidance, it's thematic level guidance, and the underlying format is really not what's at play here.
Yes, Adam here. Could I just add that I think the sort of the landscape we're in, though, that if you're in a hard to abate sector, whatever sort of grading of bond or label of bond, you're going to need to demonstrate this kind of information across all of them, quite frankly, because we're in that stage where your credibility, your ability to have a strategy and how that intersects with whether this is a sort of a specific green intervention here or enabling you in the transition, the core entity itself is going to have to be answering these questions and demonstrating its approach in that context. And I also think as we build out our understanding of the transition and the net zero paths we're going to need across key sectors in these hard to abate sectors and through their value chains, yes, you probably will see a sort of a set of criteria that will become more defined around how do we enable the transition in the steel sector, and the sort of the need for bonds to really play a very active part in this. So my view today, this is hugely helpful in providing this foundational piece and context that enables that really further detailed dialogue that needs to take place between investors and issuers. And I think that's the opportunity off the back of this.
I have a related question, which has also come up, and I think it's, again, I think it's in the same space. It is, how does this approach that we are proposing with the handbook differ from some of the transactions in the market that have already labeled themselves as transition bonds over the last 12 months or further?
Maybe I can take this. While it is obviously up to issuers to name their bonds in a certain way, a lot of issuers from sectors that this handbook was designed for have in the past already issued transition bonds. However, a comprehensive and globally accepted guideline as to how to structure these types of instruments credibly and specifically has so far been missing. And I absolutely believe that Climate Transition Finance Handbook can and should fill this gap. And I would highly welcome and encourage that issuers consider and make reference to this handbook when it comes to structuring their transition bonds. So I would definitely also concur with Adam here.
Changing from the theme we've just covered, we're getting quite a few questions on the roles of external reviews. I was wondering if someone could take that question and explain succinctly, how external reviews work with the guidance for the handbook.
Sure, I can take that one. So I guess one piece of work that will come out in early next year is an adaptation of the ICMA's external review template to incorporate also alignment to this handbook. But in the meantime, when reading through it, you'll see that for each of the elements, we have included a discussion around what kinds of verification might be appropriate. And I think our purpose here, again, thinking through the fact that a lot of issuers are already obtaining verification of things like their science-based targets or with regards to their broader sustainability and transition strategy, we didn't want to imply that there needed to be a duplication of that verification, but rather that it needed to be referenced in conjunction with alignment to this handbook. So I think the target here is to look at what elements and what disclosures issuers are including, and ensuring that there is verification and assurance of each of those, but just acknowledging that it might be happening at the issuer level already, or it may need to happen in conjunction with a specific debt instrument.
Staying with you, Farnham, again on this topic, there is a question that's come up several times on whether external reviewing should be dynamic, and this is something which we've covered perhaps with sustainability-linked bonds, with regular checks on the KPIs and the sustainability targets, but maybe you can address that also. I mean, how dynamic is external reviewing in the context of transition?
So I think keeping in mind that around the third element in particular, around science-based pathways, we're acknowledging that many issuers will be starting with impartial disclosure or an imperfect disclosure potentially, but of course making clear the kind of long-term objectives and pathway that they're going down. I think it does make sense to think through the fact that in annual reporting, you would have an update of those elements as well if you were doing something on a use of proceeds format, and further discussion on how the use of proceeds for a green bond instrument, aligns back to the issuer strategy and the targets that have been outlined in element 3.
Thank you very much. There's a number of questions on how the handbook relates to the work that's going on in the EU, sponsored by the Commission, and particularly with respect to the EU taxonomy, where there is a framework to determine transition. Who would like to take that one?
So I can start, and I'm sure others have a view. So firstly, we should welcome the work of the EU taxonomy, and it was a big part in shaping the discussions that we had within the working group. So there is a component within the EU's work that looks specifically at this question of transition. And obviously for those that are tagged currently, but maybe so in the future, of course, there is this alignment. And in the EU, there are quite specific standards that have been set, which the current science suggests will be aligned with 1.5 degrees or net zero by 2050. Now, this is also a component where we had to take the global view. So the EU taxonomy was a big part of our thinking, but not the only one. And we were very keen to ensure the voices from countries such as Japan, Australia, Canada, the emerging markets, for whom the climate transition is a genuine challenge for these large entire economies, was something that we should also reflect. And so we didn't choose to select just one standard over others, and that this should be something that stood the test of time, but also was inclusive and global in nature, and predominantly was really about how could this be adopted within the context of each individual issuer and their market and sector conditions. So that's what I would say about it. I'm sure some of the other members of the working group, who are involved in this discussion would have a point to say about this.
Yeah, I mean, all I would add is, if I like draw an analogy, in the same way that the green bond principles are not prescriptive in dictating the definition of green and what is an eligible project, they are very much process-driven guidelines, and it's allowed the market to innovate and grow and adapt. In the same way with this handbook, it's giving disclosure and transparency-based guidelines, but not dictating exactly what is or is not, if you like, in a taxonomy. And we recognize there's other pieces out there. There is the EU taxonomy. There are other parties as well who are looking to put out guidance, whether it's be sectoral based guidance or whether it's technology based guidance and other elements as well. And any issuer can, of course, work with those and use those and transparently disclose them as part of their journey. And I think, we've heard a little bit from Susanna on the panel about the way they, Repsol takes scenarios and runs analysis and looks forward. And we heard the same from Sergio at SNAM around thinking about the different scenarios and then applying their own in-house expertise on top. So that's how I see this really playing out. It's about transparency and those guidelines.
Thank you very much, Robert. There is again a question on the EU, which I will actually propose an answer to as a member of the EU platform, and see if anyone disagrees with me. But there's a specific question on how this relates to the proposal for an EU green bond standard. And the answer that I would propose is that once the EU GBS is operational, I don't see any reason why an issuer choosing to use that standard could not also reference the guidance of the handbook alongside the guidance that the taxonomy will be providing, because an EU GBS by definition needs to be aligned with the taxonomy, but an issuer may decide that they also want to align with the handbook and use that framework. Does anyone disagree with that comment? I don't hear any voices, so we'll move on then to the next question. There is, I think, a interesting comment on how this guidance could apply to sovereign issuers. We have the opportunity of having corporate issuers on the panel, but one of our participants or delegates is asking us, would the handbook also apply for a sovereign issue? Who would like to take that?
Johannes, I'm just throwing you out there, but perhaps from the investor standpoint, be keen to hear your views, and then I'll obviously share my perspective as well.
To be honest, I just really had to think about this comment, but with the various components of the Climate Transition Finance Handbook in mind, I see a possibility to combine these as well. I mean, obviously, we've had the harder to abate sectors, especially in mind, because we haven't seen those come to market frequently, as opposed to, for example, sovereigns or SSAs, which have been, picking up in market activity recently. So, in general, I would say, though, that the Climate Transition Finance Handbook more broadly is a tool to more credibly signal in the market your willingness as an issuer to make the transition. So in general, yes, but I would have to think about the details, to be honest.
No, look, Adam here, just to add, I mean, I think that it has the potential, the principles have the potential. I think the part of the challenge is that perhaps you haven't quite got the independent tools evaluating the sort of the country level transition plans and how that sort of translates through to the interventions they need to make. I think you've got that sort of spread in a number of government announcements, but I don't think there's quite the investor tools in the same way. I think tools like TPI are looking to provide that through a sovereign bond assessment. And I think as that kind of knowledge sort of gets catalyzed and emerges in the next 6 months, I think there's space equally for this kind of framework to be applied as well. So I think there's a real space for that and a need for it. And I'd say equally, the wider sort of investor engagement is absolutely going to be critical to that as well, because ultimately you need companies to be setting targets, strategies, and alignment. You need governments to be doing the same. There's a role for finance and enabling in all of those contexts, but we want to ensure there's credibility, as we've been saying throughout this, across all of that.
I agree. I see the interconnectivity as well. I mean, Sergio, you mentioned earlier, of course, how a lot of what you're doing is to be, of course, aligned with what Italy's looking to achieve, and of course, what the EU's looking to achieve. In my mind, there is no reason that the transparency, the guidance, and the forward-looking nature of the handbook can apply just as equally to a sovereign. I take a slightly different view, contrarian view to you, Adam, in that, does a sovereign need to wait for a dedicated, sovereign level analysis like a sectoral analysis? I would suggest not necessarily, in the same way that, in the discussion earlier, we heard that not all companies are at different points in the journey, and ultimately it's about having that acting seriously, as we heard from Sergio. It's about the credibility, and it's about deepening the dialogue with investors about where am I today, where do I want to go, how am I going to get there, and providing transparency across all of that and the materiality. Can that apply to a sovereign? I would argue yes, absolutely.
Yeah, I don't disagree.
Okay, there's a question on whether the climate transition handbook and its guidance increases the focus on an issuer's commitments and at the same time increases the reputational risk for issuers. You know, do you concur with that view? You know, that we're raising the bar here for issuers who are going to commit to this guidance.
Yeah, just a quick comment from me and then move to Sergio. So I think it will have the reverse effect. The point of this document is to give assurance to corporate issuers in these hard-to-abate sectors, so-called hard-to-abate sectors, carbon-intensive sectors, to be able to come to market with confidence. And so by at least either meeting or attempting to meet, that's the piece that I would highlight as an investor in these types of securities. It's about the attempt is also important. You know, you might not be fully there yet today, but we're attempting to, and this is how we're trying to do so, is a good signal to us as investors of the forward direction of the company. And that's what we're interested in. So from that perspective, and please come and speak with me, corporate issuers, at any time. You're very welcome to reach out to me. But yeah, this is something I would say is that this is here to provide you confidence that you could come to market without worrying. And you know, and Sergio's obviously probably has sleepless nights about.
No, I think it's not a bad thing if someone feel the pressure coming from the market, because again, credibility and track record, it's everything in the market. No, so if the issuers feel the responsibility, I think it's not so bad. In our case, and then I leave the ball to Susanna, of course, we already feel a lot of pressure because given the featuring characteristic of the business, we are an infrastructure company, given because the interconnection with the Italian government, the Italian policy, the European legislation and the European targets. So we already feel this pressure, and the environmental teams are already well embedded in our strategy and day-by-day activities. On the opposite, I take the good of today's handbook. It, as mentioned before, I don't want to repeat myself. It offers us a fertile ground, a fertile playground to engage with investors and rating agency, giving each other the benefit of the doubt.
Yes, thank you, Sergio. And Joe, I totally agree with Joe. I mean, this is an opportunity for issuers. It's true that is a requirement. There are requirements, transparency, etc. But once you, as an issuer, have a credible, a strong strategy, you have sustainability in your DNA, etc., etc. You have a pathway. So this is a very good thing, because this sets the standard of this financing transition framework. For example, Repsol now is working on a transition financing framework to accompany our strategic plan. And for us, this framework is good to include the key elements that are included in the handbook. So for us, this is a good thing. I mean, it for sure is a responsibility, and it's not an easy journey for sectors like ours. But for me, this is a very, very positive initiative.
Thank you. I've got one more question then, maybe for the Q&A. We're being asked, or the comments being made, that there's a lot of focus in the guidance of the handbook about future commitments. But what about outcomes? How is that taken into account? How is that monitored? Maybe that's one to start with Farnam.
Well, I think you've heard from the investors on the panel today. You know, the disclosures are there as a point of engagement, but you know, ultimately, companies are also going to be held accountable to what they are disclosing and the trajectories that they're putting forward. And so I think that the emphasis on outcomes will come in the lifetime of the bond as companies evidence, you know, the plans and trajectories that they're putting forward. I think Adam's come off mute, so I'm hoping.
Yeah, no, just to add to that, I mean, clearly you can have a long-term commitment to net zero, but you need to convert that into short, medium-term targets, and then you're going to be tracked on your delivery and your strategy against that. And I think this is where there's that relationship between where is it you also need the injection of finance to help you achieve that. And I think this gives you a framework to be able to do that. But clearly you're going to be looking at that delivery. So it's looking and measuring you against those long-term, but at the same time tracking you against that and your trajectory. And that I think is all going to be transparent. It's all going to be in independent tools such as TPI and others. And I think that's how you build the confidence and you enable further investment.
And it's also, just adding in on the end there, it's also, of course, where the sustainability linked bond format is very well suited in setting those ambitious, material, relevant, forward-looking targets as well, to be able to do that.
If I add one point to following up what Adam said, we perfectly agree, no? Because we have a long-term target, which is by 2040 be zero emission in 2040. So I think it's the most ambitious target in the industry, and it's well in advance the 2050 target of Europe. But meanwhile, in order to make our long-term target more solid, we set at some intermediate targets, which is reducing by 50% our scope 1 and scope 2 emission by 2030, and to reduce methane emission, which sometimes is even more dangerous than CO2 emission, by 45% by 2025. And if some of the investors attended our roadshow in the last few years, they noticed that we accompanied our category of investments with the KPI expected. So with the results expected from this action. And we produce at the end of every year, the progress of the investments and the KPI, the result of this action. Just it's because it's not only long-term dreams, but because it's day-by-day activities, and we have to show the financial community, again, our track record and our delivery.
Very good. I just want to ask Yo and Robert, is this something you feel that we haven't covered in the Q&A that you would like to make a final remark on?
One thing to say is really thanks again to everybody, because this has been a big effort involving lots of people, and many of us have worked under very, very difficult personal, professional circumstances because of COVID. I think the other thing to note is that this isn't the end of the process either. So we will continue in various forums and various ways to inform, educate, train, engage, etc., to kind of foster the understanding and implementation of climate transition finance.
Yeah, completely echo everything Yo has said there, and just if it was to pick out on the two key phrases that resonated for me from the panel session, one, acting seriously, and the other one that we've heard a lot and repeatedly, materiality, and actually having that material dialogue. So yeah, thank you.
Well, that's great. And I'll add my warm thanks to everyone, speakers and panelists. This has been a really interesting session, and also add, ICMA's voice to all of you who have contributed. It's been a long road. It's been brilliantly managed by the coordinators. I think the outcome is substantive, and we've all done this indeed under extraordinary and often personally difficult circumstances. So I think that that really should be underlined. It's now over to the market to make good use of our guidance with the handbook, as with the other guidance that the GBP SBB are providing with ICMA support. So I can only encourage all of you now to continue to demonstrate the powerful contribution that sustainable finance can make to mitigate the challenges that we're faced with, and especially climate change, but sustainable challenges more generally. Coming to the announcements, I wanted to tell those of you who want to deepen their knowledge of what we're doing in sustainable finance with the green and social bond principles. We have at ICMA now developed an online course. You can find this in the education section of our website, www.icmagroup.org. We also produce regular podcasts and webinars on sustainable finance topics that you can find listed on our new media library on our website. With that, again, many thanks to all of you. This has been, I think, a very important and interesting online session. So we thank you, and with that, we will close the event.